Hello, everyone. We are going to get started in just a minute. Just give everybody a chance to file in. Okay. For American Friends of the Hebrew University. I'm pleased to introduce today's AFHU-sponsored Plan Giving webinar, Estate Planning, What to Do When the Lifetime Credit is Reduced, presented by attorney Neil Meyerberg. Neil has extensive experience in tax and financial planning strategies with an emphasis on charitable giving techniques. Neil will share his expertise on estate planning and things you might want to consider when reviewing your planned giving options. American Friends is proud to present this webinar series on planned giving. We hope you do well while you're doing good. And the good, of course, is joining AFHU in raising awareness and funds for the Hebrew University of Jerusalem. Hebrew University is Israel's premier institution of higher learning with a commitment to delivering a quality education to its diverse student body while producing world-class research and dynamic innovation. American Friends of the Hebrew University has created the Einstein Visionary Society to recognize generous donors who have created their own personal legacy by including AFHU in their estate planning, such as through a bequest or a life income gift. The society is named for Albert Einstein, a founder of the Hebrew University, who bequeathed his vast intellectual legacy to the university. Our legacy donors are invited to special events and receive special recognition. Please contact us for more information at plangiving@afhu.org. Just a reminder that this presentation will be recorded and the slides will be available upon request. Neil, over to you.
Thank you, Brian. I'm going to share a screen with everybody and welcome everybody to the program. The topic, as you can see, is estate planning, and it's highly relevant, always relevant, no matter what the course of the law is. I can remember a year and a fraction ago, time is just passing so quickly, that we were debating the concept of what the initial administration proposal was for taxes and estate planning, the reduction quickly of the unified credit, we're going to call the lifetime exemption, the fact that maybe there would not be step up in basis for stocks, all the things that concerned us in 2021 and 2020. And here we are in 2022, midway through the year, and none of those possibilities occurred. What happened, in essence, is we're in the same scenario we were before those proposals, waiting for 2025 to end when the lifetime exemption goes back to a more modest amount. I use the word modest in quotes. And many people who do estate planning really aren't terribly concerned about the lifetime exemption because whatever size it is, most estates aren't at that level. But nevertheless, let's talk about this in the concept of gift estate tax lifetime exemptions. This is where we are now. In 2022, the lifetime exemption is now at $12.06 million, say $12 million per person. And the important thing to note is, under the tax laws that presently exist, unless they change, lifetime exemption will drop at the end of 2025. So this is a 2022 number. It'll continue to increase under the formulas until we get through 2025, in which case it'll drop back to some level, somewhere between 6.2 and 6.5 million, we believe, because it's based upon $5 million plus an index for inflation from 2010. As we know now, the recent inflationary numbers will make this come much larger than we predicted it was going to be. So when you're looking at estate planning beginning in 2026, we can talk about maybe 6 million to 6.5 million to be the gift tax lifetime exemption. How do gift taxes work? This is an important concept when we talk about gifting, because gifting is what we're trying to do to keep ourselves under thresholds. Gift tax exclusion, which is different than the lifetime exemption. Exclusion is an annual exclusion per donee, is now $16,000, meaning that each year, this year, you can give $16,000 to as many people as you like, with neither you nor the recipient having to report it as a gift. It's not a taxable gift if it's 16 or under. And you can give that amount in a single calendar year, and you can give it to recipients and just multiply the amount you give by the number of recipients in order to find the concept of how it is used to eliminate gift taxes. So essentially the exclusion is per donee, per year, the number of donees, and doesn't require you to use your lifetime exemption. The thing about the lifetime exemption, though, which is sometimes difficult, but important to note, is the issue of portability, and it still is an important issue. Portability is the ability of a couple, spouses, to use each other's estate tax exemptions. So for example, if it's 12.06 million per person now for 2022, that means it's $24.12 million for a couple. So when you do estate planning with spouses, there is the issue of portability, whereby if the first spouse's amount is not used fully, and the surviving spouse wants to make use of his or her amount, can also include the amount that was unused by the first spouse. So in planning, you've got this long stretch of being able to use, in essence, a full amount by picking up the unused portion of the deceased spouse. Portability is not automatic, as I point out here. And this is interesting because there's a recent case to discuss this. In order to become a portable item for the surviving spouse has to file a federal estate tax return and make the election. Now, most surviving spouses perhaps wouldn't have to file an estate tax return, but the law is it has to be done. In a recent case, there was a debate with the tax court and with the IRS with respect to whether or not, if you did make the election, if you're forfeiting the right to make the election. In that case, the court looked at the facts and allowed the election to be made, even though the federal estate tax wasn't returned on time. The advantage of portability is flexibility. It allows both spouses to go about estate planning and transferring assets and carrying out wishes. The surviving spouse can execute much of the plan at the end of the lifetime of the first spouse by using the first spouse's unused amount of the exemption and the surviving spouse's full amount. Interesting, portability is limited to the estate and gift tax exemption. The exemption for generation skipping transfer tax is not portable. So when you're doing this, if you watch this screen, portability is essential in planning, and just be aware of how you go about making portability occur. So let's reduce an estate somehow. One of the things we're trying to do is to find a way to stay below the thresholds. And for those of you who are listening who don't really worry about the thresholds, just to find some strategies to doing some estate planning. Use the annual gift tax exclusion. You can see in bullet point 2. In that instance, we're talking about making gifts to individuals or trusts. So if you have 3 children and 6 grandchildren, I want to give them the maximum amount, which is $16,000 per year. That means in essence, you can give away $144,000 a year in gifts without having to pay gift taxes. And if you split the gifts with your spouse, it's double. Now, this is a substantial number, and some families don't want to give this amount, but you're not bound to give anything other than limiting yourself to $16,000 per person. You can transfer to a trust for the individuals, to them individually. You can build some programs whereby the grandchildren will have money for university. There's all kinds of ways to do this, but the annual gift tax exclusion has been around a long time. And many people use it to the extent they are willing to free up their capital to benefit children and grandchildren. The second thing you can do, obviously, because it's a full deduction from the estate, is to make charitable gifts during lifetime or after lifetime. And one of the things that we were worried about in the first presentations by the administration was whether or not long-term capital gain assets would be available for deduction at full value, and gain would not be taxed, but it's still going to be the same. You can make gifts of capital gain assets, stocks, bonds, real estate, mutual fund shares, works of art of any sort, and transfer them directly to charity. They're removed from your estate. They're deductible for income tax purposes at their full value. Now, you can do it either during lifetime or obviously in your estate planning. In any event, if it goes to charity, it's out of the estate. From an estate point of view, estate planning point of view, it's not subject to estate tax. The capital gains tax is avoided if you give during lifetime because you're not selling the assets. They're being contributed to the charity, and the charity is selling the assets, and the charity pays no tax. And number three, you can make contributions to charity to designate programs or purposes, or as many people do nowadays, they create endowments that take effect after lifetime and perpetuity. You can also use them to fund a private foundation, a supporting organization, or donor advised fund. One way of avoiding estate taxes on assets owned after lifetime is to leave some of them to charity. They're fully excludable from estate and gift taxes. You can also, during lifetime, for those of you who are 72 or older and required to take required minimum distributions, many of you know this, you can make a contribution of any or all of the RMD year by year up to $100,000 to charity and withdraw the money, therefore, from your IRA at no tax cost. If you have a 401k and not an IRA, you can do the same strategy, except the 401k needs to be rolled over to an IRA before you demand the RMD withdrawals. They have to be sent straight to charity. But in essence, many of you who make charitable contributions year by year, who are over or at the age of 72, required to take RMDs, probably already do this. Any of these dollars that come out from the RMDs, which are money that comes out of your IRA, otherwise would be taxable in your estate, would not be taxable because it would be directly given to charity. You can use a donor advised fund. And again, this is part of the strategy that people use. I suspect that most individuals take on two particular tasks in doing their estate planning. Number one, how do we give to family? How do we give to heirs, to spouse, to people very important to us? How do we make a difference to those individuals' lives, either outright gifts or gifts to them in trust, or gifts to them that pay income to them for life and lives? That's a priority for most of us. But we also have a second priority, most of us, and that is to do something special for the organizations we've been supporting during our lifetime. We may not have been able to support them in the amount we want to because we wanted to keep our capital intact. But at the end of lifetime, we might want to, for example, create a donor advised fund. And many organizations have donor advised fund programs, both in the commercial world and the charitable world. You make a transfer to the fund. After lifetime, it goes in as a charitable contribution deduction. You can include other members of your family as recommenders of grants. It's a way of having what in essence is a private foundation without having the expensive private foundation. And again, I suspect many of you on this webinar have done this already. It's a way of perpetuating charitable giving for the family. And when you make a contribution to build your donor advised fund, if those assets grow in value because of the asset allocation you've recommended, the growth in value is tax-free, also available for you to use for charitable contributions. You can use a charitable remainder trust. Charitable remainder trust is extraordinarily important and valuable for many of you because it enables you to create a trust that will provide income for life or lives at a stated rate or an adjustable payment based upon a stated rate, and allows you to do it with assets that have capital gain embedded that won't be taxed initially when they're received by the trust. So you can see contributions of capital gain assets to a CRT, charitable remainder trust, are not taxed on capital gains, and oftentimes the liquid assets, troublesome assets from an estate planning point of view, real estate, art, collectibles. Why are they troublesome? Because of valuation questions. At the end of lifetime, many people wind up having real estate pass through their estates, and the expense of having the real estate in the estate, the expense of the appraisal, the expense of the sale. Is the sale going to generate full value because it's being sold by an estate? The same with art and collectibles. It becomes very difficult in administering estates, and there are commissions and fees both to the executors and to the professionals. So there are ways to deal with that by transferring these assets to a charitable remainder trust during lifetime or after lifetime. And you can have multiple beneficiaries. It can be you, if it's done during your lifetime, spouse, could be children. It could be, if the calculations allowed, even grandchildren. It can run for life or lives or a term of years up to 20. And there's an income tax deduction for doing it for part of the contribution. But this is an important factor to go over with your estate and tax planner. We now have a high AFR, a high inflation rate. Income tax deductions, because it's so high now, are larger than they ever been for CRTs before. So when you make a contribution now with a high federal rate, which is the discount rate, it's now 3.6, 3.8%. It means the tax deduction for doing it is considerably high. And for many of us, an income tax charitable deduction offsets some of our AGI and can be very valuable with a gift or a lifetime. And I point this last piece out to you for a conversation. That is, for some people who say, I would like to use a charitable remainder trust, I'd like to support a charity at the end of the trust term, I want to provide for my children, for my spouse, for myself. But if I do that, aren't I reducing those assets from being distributed to my heirs because I've actually laid them into a trust that goes to charity? The answer to that is yes. However, if you use a wealth replacement strategy like life insurance to create a separate trust called an irrevocable life insurance trust, it's possible mathematically for this trust to end in the benefit of the charity and this trust to end for the benefit of heirs, so that the heirs will receive the assets in the second trust, the insurance trust, free of gift or estate taxes. What about a charitable remainder trust under IRA planning? We know now the new rules about IRAs, and that is we no longer have the stretch for many individuals. The stretch used to allow us to pass an IRA on to a beneficiary, non-spousal beneficiary, for example, and that beneficiary would take withdrawals from the IRA year by year based upon life expectancy tables and only pay income tax on that withdrawal. So it was a soft landing in terms of how much to take out and how much income tax to pay. But for many of those who would be the heirs of your IRA, that no longer exists. We now have the 10-year rule. When they receive it, they have 10 years to take out the IRA and pay the income tax. And so your planning was that they would have it for life, but now the planning is going to be a little bit more strained. So how do you deal with this? Maybe what you do is, instead of the IRA being stretched and passed to the heirs directly, you put the IRA at end of lifetime, all or a portion of it, to a charitable remainder trust, payable for your heirs, spouse, children, grandchildren for a term of years or for lives. And that going into the IRA means it's not going to be part of your estate, the IRA going into the charitable remainder trust, excluded from your estate, passed to the charitable remainder trust. It replaces or expands the stretch. The charity receives the remainder interest, of course, at the end of the term, as we've said before. But this way, the IRA stretch has been expanded because you're using the charitable remainder trust to receive the IRA, and that can pay for the life or lives of your heirs. Note at the bottom, I'm saying use wealth replacement planning or life insurance, as I said in the prior screen, may enable you to provide for heirs some of the capital otherwise got into the charitable remainder trust, income to them for life, but will be going to charity at the end. So again, charitable remainder trust has been around a long time. They're used quite often, but the use of them for the IRA scenario is really relevant to estate and tax planners now. Two examples, and I'll skip these very quickly, just point out to you, you might use an IRA into a charitable remainder trust if there's a disabled adult child. So you make adjustments of payments and you make certain that there's payments for the adult disabled child, but they would be part of a special needs trust so that there would not be any denial of entitlements. And number two, you might be able to do it with a family of 2 adult children, and then it passes on to the survivor for their children. So these are things to ponder in estate planning with respect to IRAs. IRAs, qualified plans, can all be very costly in estate planning, particularly if the IRA or the 401k or the pension or profit sharing plan is part of the collection of assets in the estate. They would be part of the estate for probate purposes and part of the estate counting in terms of seeing whether there would be any federal estate taxes. So be alert to that, particularly since many of you may have substantial assets in IRAs or other qualified plans, and you need to have some planning ideas. So long now as we have this large lifetime credit amount, we're okay, but what happens in 2026? There are GRATs still, and many of you have thought about GRATs, the idea of transferring assets to a grantor retained annuity trust, where the grantor, you, for example, receive annuity payments for a specified term of years. This is also tied to that AFR I said before, which is high. So the calculations have to be really massaged carefully when you're doing this kind of planning now. The grantor who sets up the trust receives the annuity, pays tax on the annuity, but it's fine because as long as the grantor outlives the trust, it won't revert back to the grantor's estate. So we really remove the asset from the estate. And my last sentence on the bottom of this bullet point says, for the reason that one doesn't want to die while the trust is still running, advisors often recommend shorter terms for older clients. So the GRAT is still there. The whole calculation scenario is impacted significantly by interest rates that are part of the IRS's monthly discount rate called the applicable federal rate. When you talk to your tax estate financial planner, I'm sure the conversation will come up about how do we make our planning in light of the high FR? How long will this high interest rate environment stay? The AFR a year and a half ago was below 1%. Now it's well in the midst of between 3 and 4%. It has tremendous impact on annuities, on remainders, on charitable giving, and on GRATs in general. A GRAT is not a charitable contribution transaction. It's a way of getting an asset out of the estate.
Hey, Neil, we have a question.
Yes.
If an IRA is used to fund a CRT, does that impact the tax deduction?
If an IRA is used to fund a CRT after lifetime, I suppose that's the point after lifetime, the IRA going into the CRT, there is a consequential income tax, estate tax charitable deduction for the portion that is charitable in calculation. The balance of it would be subject to estate taxes, but that's what you would use and apply some of your lifetime exemption to. I guess mathematically, if you're exceeding the lifetime exemption, a portion of the IRA going to the CRT would be subject to estate tax, but good planning ought to make that untrue. If you do it during lifetime, and most people don't, but if you use an IRA and transfer it to a CRT during lifetime, the withdrawal of the IRA into the CRT is a taxable event, ordinary income tax, because it's IRA distributions. There will be an income tax charitable deduction for the CRT, which will offset some of that income tax vulnerability. Question becomes, Brandon, for the questioner, is it going to be done after lifetime through the estate plan or during lifetime by the withdrawal? I recently did an IRA transaction into a charitable remainder trust during lifetime. The donor knew there was going to be substantial tax, but the donor wanted to move the assets out of the IRA now, was willing to pay the front end tax and create the charitable remainder trust because of other family planning benefits. What else should we think about? This is as we close this conversation. Let me just step back for a moment and remind you, this is what we call a mini webinar. The idea is to put some subjects in front of you, give you an opportunity to see what the thought process is and what the state and tax planners are thinking about, give you the opportunity to have the outline and to have the recording and to talk to your financial advisors. I would think this year, more than years hence and years past, it's an excellent time to be talking to your planners, because there is some stability in this planning idea that we may get to 2026 under the formula we now have, but we always need to be wary of changes that may occur in legislation. So here's some other considerations. Number one, giving, if you're going to make gifts during lifetime, give assets expected to appreciate in the near term. So if you're giving assets to individuals who are going to be your natural heirs, you're giving to them now their lifetime in whatever form you decide, get rid of the appreciation so that you don't have the appreciation in your estate. Gifting assets expected to appreciate in the near term may be an advantage in making gifts over those that may be expected to appreciate more slowly. The big gains now, the big assets that you have now that you expect when markets become more normal, become more substantial in value, ought to be the ones you're considering making gifts of now. And I'm not talking just about charitable giving. I'm talking about the concept of estate planning, where you have this balancing scales of taking care of family and perhaps taking care of charity. So give the assets they're expected to appreciate substantially in the long term. Number two, how about assets subject to valuation discounts? There are some assets that you may be able, because of lack of marketability or lack of control, to take a discount from. This has always been an interesting conversation between planners, their clients, and in a subtle way, the IRS. How much discount can you take? So we're talking about, for example, if you have an asset that would otherwise be valued at $10 million, but you have a valuation discount of 20%, then the asset's now $8 million in your estate. So you want to think about valuation discounts as long as they can be sustained. So I point out in my last sentence, the valuation discounts should be determined by an appraisal performed by a qualified appraiser. Now that's a double statement of essence, valuation and a qualified appraiser. You want a qualified appraisal by qualified appraiser. Sometimes people get their appraisals from people who are in the business, but aren't held out to be appraisers, and that can be problematic. So if there's a valuation discount, a family business, for example, a piece of real estate that's not easily marketable, works of art, things that are justifiably discountable because of their lack of marketability or the fact that there's no control of the entity that you are trying to donate to count, you would simply look at a valuation discount. Number three, and these are two subjects that people are committed to and have sometimes difficulty in finding out the exact way to plan: family business interests. Now, transferring family business interests by way of gifts to the next generation, you have children in the business and you want them to be owners of or have a more substantial position in the business. If you made interest transfers to them, discountable or not, it may have gift tax implications, in which case you would have to use your lifetime credit, or of course you could use annual exclusions, but they'd be quite small in light of what you're trying to do. If you want to sell the business to the next generation, some families think about, well, maybe we can sell the business to our children. Well, that's possible. There are tax implications to doing that, including taxes on gain and imputed interest. But you want to be certain if you sold the business to the next generation, they're using the business to pay you for the sale. Will the future business cash flow be adequate to make the sale price? Will be able, therefore, to enable the children to grow the business and preserve the business? So the complexity of doing family business interest planning goes deep into the issue of financial projections, of discounts, of control, of cash flow. So selling the business does become conceivable, but you measure the tax costs and the way it may hamstring the business before you make a decision about selling it. And if a family ownership is desired and the business is to continue, it might make sense to gift some of the ownership interest in the family business, eligible, we hope, for valuation discounts. And this is what people go through a great deal. And I know many of you who are thinking about it, it may be something as simple as a family ownership of a piece of real estate, something you've all invested in, a commercial real estate or investment real estate. These are things that you have to plan, and your estate planning at this point is supplemented by the very substantial estate and gift tax unified credit lifetime exemption. The last thing to think about, and I leave this for you to ponder, there is a case called Palmer and a transaction called Palmer that deals with the transfer of C Corp transfers, C Corp interest. So if you have a business interest and it's classified not as an S Corp, but a C Corp, a business corporation, and you want to make gifts of some of those shares in that corporation to your family, and those shares have substantial value, and by giving it directly to your children, there would be gift tax implications. A Palmer transaction gets a big step away from that. In a Palmer transaction, you're making a gift to charity of those shares. That gift gives you an estate or a gift or an income tax charitable deduction. You can give it outright to charity or to a charitable remainder trust. What's important here is there is an understanding, but not a binding commitment, that your corporation will buy those shares back from the charity. Charity doesn't want to be a shareholder. You don't want the charity to be a shareholder, by using some free cash, some cash that the corporation has accumulated that would be taxable if it comes out of the corporation, but would not be taxable if it was used for an investment. So the corporation issues some tax directly to the charity. buys the shares back, retires them in the corporation. Thus, there are fewer shares outstanding, and the children's existing shares have a greater percentage of the ownership of the corporation. The corporation intends to redeem the shares and retire them. It's a way of using charity as a partner in this, and it requires you to pay no gift taxes and no estate taxes on children's receipt of interest in your C corporation. So in essence, it's a way of considering how to deal with this more complex subject of how to shift assets generationally. And for final thoughts, I'll read with you. It's unclear what the exemption is going to be beyond 2026, but we certainly don't expect it to stay as high as it currently is. In 2026, which is some years hence, any number of things that happen in Congress, Congress could essentially go to where it once was proposed a year and a half ago, to make it $3 million. Congress could simply extend 2025 beyond and stay the same formula, but we don't know. So estate planning is dealing with what we do know and what we can't know, and putting in some safety measures to be certain that the estate planning will work. It's a challenge for you. It's a challenge for your planners. It's a challenge for all of us. But the best thing about it is we have tools, we have ideas, and we have things we can use to make it work. I thank you for attending. I hope it's been helpful. AFHU is pleased to make these programs available. There'll be more mini webinars in the future on comparable topics involving estate and tax planning. And I welcome your questions by email to AFHU, and you can send your questions to plangiving@afhu.org, and we'll respond back to you. Brandon, I turn it to you.
Thanks so much, Neil, for this very insightful discussion. Just a reminder that there is one more session coming up in September. If you have any questions, please email plangiving@afhu.org, and we'll see you next time.
Bye, everybody.